Okay. So we said several times that the financial statements prepared by accountants cannot be taken as given. We need to restate the financial statements in order to classify items properly. We need to make a clear distinction between operating items and financing items, right? Last week we introduced some basic concepts and also dealt with the statement of shareholders' equity. We saw how to clean the statement of shareholders' equity and restate it such that everything there belongs to the common shareholders' equity, right? Okay, today we continue the process by seeing how to restate the balance sheet and the income statement. Again, the key idea is to make a clear distinction between operating items and financial items. Okay? Remember again that operating activities are the main source of value. This is the standard balance sheet. This is how a standard balance sheet looks like. Normally we have assets on one side and liabilities and equity on another side. Assets are usually classified as current assets or long-term and fixed assets. Liabilities are also classified as either current liabilities and long-term liabilities. Then we have equity, and the two sides must be equal. When we restate the balance sheet, we move operating items, we put them together, and financial or financing items, we put them together. So this is how we restate the balance sheet. We discussed this point last week, I think. So we move the operating liabilities from the right-hand side, we put them along with operating assets, and we calculate the difference between operating assets and operating liabilities. Okay? So we have here operating assets minus operating liabilities, and that gives us the net operating assets. And we move the financial assets from the assets side, we move them to the liabilities side, and we combine them with the financial liabilities or obligations. Remember that financial obligations is the same as financial liabilities. And then we take the difference between financial obligations and financial assets. We get the net financial obligations. Then we plug the common equity, and then NFO, the net financial obligations plus common shareholders' equity, must equal the net operating assets. Now let us see what kinds or what types of assets and liabilities that should be classified as financial. On the assets side, these are the financial or the assets that are usually classified as financial assets. We have cash equivalents. Cash equivalents are very short-term and highly liquid debt securities. So cash equivalents means debt securities. They are almost similar to the cash because they are short-term and highly liquid and can be converted into cash very, very easily. That's why they are usually treated as if they are cash, but they are in fact, they earn interest, and that's why they are debt securities held by the firm, so they are financial assets. We have also short-term investments. These short-term investments also are usually debt securities earning cash or earning interest. We have short-term receivables. This one needs further discussion. We will discuss them in greater detail shortly. We have long-term non-marketable debt investment. The word debt is enough to tell us that it is a financial asset. And we have also long-term marketable debt securities. Again, the word debt also is enough to tell us that it is a financial asset. All other assets are to be treated as operating assets. As you can see, all of these items, they have the nature of lending. We are talking about lending. Last week we discussed a variable called F. net cash flow to borrowers or lenders, if you still remember, we said last week, because there was yesterday when I was giving the workshop, discussing the workshop, some students were confused. They do not know the difference between financial assets, financial liabilities, and the items under F. If you still remember F last week, we said F is equal to lending minus interest received plus borrowing. This is the amount, net amount raised, minus interest paid. This is F. You still remember F? Huh? We said that lending is the net purchase of financial assets. Interest received is very clear. Borrowing, it was formerly named as the net amount raised. And interest paid, this one is clear, this one is clear. So what is the difference between lending and borrowing, and lending here and lending here? The difference is that these items on the asset side, these are cumulative figure. They accumulate over the passage of time. This one is the lending within a period of time. So lending here is just the change in financial assets. The change in financial assets. And borrowing here is also the change in financial obligations. Make sense? This is just the incremental lending or borrowing. Make sense? Okay? So borrowing here is the change in financial obligations, and lending here is the change in financial assets. As simple as that. Make sense? Okay. So now it is very clear what or how to deal with these items. We know what kinds of investments to be treated or types of assets to be treated as financials, and how to classify or to identify the operating ones. Now, on the liabilities side, also, all items that have the nature of borrowing should be treated as financial liabilities. For example, short-term borrowing, it is borrowing, so it is straightforward, very clear. We have current maturities of long-term debt. Again, the word debt is a key word, so it is straightforward to be treated as a financial liability. Short-term notes payable, it depends. There is a question mark here. It needs further discussion. We will discuss it soon. We have also long-term borrowing, straightforward, financial liability. Lease obligations, also financial liability. Preferred stock, also to be treated as a financial liability, because preferred equity holders are to be satisfied before anything is paid to common shareholders. So from the perspective of common shareholders, preferred equity holders are like creditors. They are to be paid off before anything is paid to the common shareholders, okay? All other liabilities are to be treated as operating. And finally, if we have non-controlling interests, we add it here. It is not part of common equity, and it is not part of liabilities. It is just an independent component item to be added to the equation. If you still remember, the equation says net operating assets equal to NFO plus common shareholders' equity. If we have minority interest, we just add it here as a separate item, minority interest or minority equity. Okay? Make sense? Minority interest is the same as non-controlling interest. Sometimes it is called minority equity. Sometimes it is called non-controlling equity. All the same. Okay? All are equivalent. So let us discuss these items in deeper details. Cash. Cash, if reported independently or separately, is to be treated as an operating asset. Okay? If reported separately, cash balance or something. However, in practice, normally cash is lumped with cash equivalents, because remember, cash equivalents are very liquid, can be converted to cash easily. That's why firms in practice, they lump cash with cash equivalents together. If this is the case, it's okay to treat all of the cash and cash equivalent as a financial asset. Although some analysts in practice, they calculate the cash, or they try to isolate cash from cash and cash equivalents using some rough equation, or some, let us say, estimation, like for example 0.5% of sales. They multiply sales by 0.5%, and then that amount is treated as an operating cash. Then the remaining balance, cash and cash equivalent, minus 0.5% of sales, the remaining balance is treated as cash equivalents or financial assets. Okay? So this is just a rough way to separate the operating cash from cash and cash equivalents. Okay? Short-term notes receivables. Note that notes receivables, sometimes firms, they need money and they issue notes. And firms with surplus cash, they buy the notes because these notes, there is interest on these notes. If the firm you are valuing, if the firm you are analyzing and valuing, bought these notes receivables issued by other firms, and these notes, they earn interest, in this case to be treated as financial assets. So if it is a temporary investment of cash in order to generate interest, in this case it is to be treated, or these notes receivables, to be treated as financial assets. But if these notes arise because of a trading with customers, in this case should be treated as operating assets, and the interest on them should be treated as operating income. So remember, notes could arise because of lending or dealing with customers when we sell on credit. Okay? When we sell on a credit, sometimes customers, they sign us checks, sometimes they sign us bills, it depends. So bills are like notes receivables from the perspective of the company. So if these notes arise because of trading with customers, when we sell them on a credit, in this case should be treated as operating assets and the interest as an operating income. Make sense? So if lending, financial assets. If dealing with customer, operating assets. Make sense? Huh? Okay. Debt investment, straightforward, financial assets. Long-term equity investment, operating assets. Why is that? Because when we buy an equity stake that belongs to another firm, we are investing in the operations of the other firm, because we become owners, right? We become owners in the target firm, and so we are entitled to a portion of their profits, right? Yes, please.
When it says that debt investments are treated as financial assets for non-financial firms, how would you treat them as debt assets which is for financial firms?
It is for financial firms, money, financial items are operating items from their perspective. Okay? Because this is part of their business and operations. Taking deposit from the perspective of the bank, taking deposits from customers and lending money to customers, this is their main business and operations. So this is part of their operations. Okay? We are talking here from the perspective of non-financial firms. Okay? Non-financial firms, their main business is not to borrow money and lend money. This is not for non-financial firms. This is not their main business. Imagine that, for example, Rio Tinto, it is a mining company, right? Right? Or for example, Woolworth, borrowing and lending is not their main business or job, right? They borrow money and lend money for financing purposes, not to make money from this business. This is not their main job. Okay. Long-term equity investments, treat them as operating assets. Short-term equity investments, usually mark to market. It means they are usually reported at market value, okay? If part of a trading portfolio then we treat them as operating assets. But if they are temporary investment of cash, then treat them as financial assets. Okay? Short-term notes payable. Notes payable, again, similar to the notes receivable, there could be either one of two cases. Trade notes are operating liabilities if the interest rate is less than the market rate. Normally, this one arises when dealing with suppliers. Sometimes we buy the firm, or the firm may buy inventory or goods from suppliers on a credit. Sometimes they ask an extension or an extended period of time to pay off the amount due. Suppliers, sometimes they say, okay, we will give you more than, for example, 1 month, but we charge you interest on that. If the interest is less than the market interest rate, then these notes are to be treated as operating liabilities. Okay? But sometimes also, firms, they issue notes when they borrow money. In this case, if notes are borrowing, of course, should be treated as a financial liability. Okay? Make sense? So it depends on whether we are dealing with suppliers or we are borrowing money. Lease assets, these are the assets that are borrowed by the firm from other firms. In this case, the asset lease should be treated as, the lease assets should be treated as financial assets. And on the other side, the lease liability arising because of lease assets should be treated as a financial obligations. There are certain conditions that are to be met. If a firm borrow an operating asset or productive asset, normally these are fixed assets, okay? To be used for specific, or for example, long periods of time. In this case, the firm should recognize the value of these assets on its asset side and also create a liability, or another, the counterpart or the other side of the entry is on the liabilities side. So we have lease assets and lease liability. Make sense? So on the asset side, the asset, this leased asset should be treated as an operating one, and on the liabilities side, the leased asset should be treated as a financial obligations because it was a financing, or the other firm financed our asset, something like this. Deferred tax assets and liabilities, straightforward, operating. If it is an asset, it is an operating asset. If it is a liability, it is an operating liability. Common dividends payable should be treated as part of shareholders' equity. It is not a liability. It should be removed from the liabilities side and added to the beginning or closing balance of equity, as we did last week. You remember what we did last week? Huh? Okay, beautiful. Preferred stocks or equity, sometimes this is called preferred equity. Straightforward, financial, it is a financial liability. Okay? Minority interest or minority equity, again, it is a separate item to be treated as a separate item and added to the equation like this, okay? It is an additional item to the equation. When you analyze the financial statements of firms or any firm, please pay a close attention to broad-named account like other liabilities. What do you mean by other? What do you mean by other assets? What do you mean by accrued liabilities? So go to the footnotes and pay a close attention and try to reclassify any items that was improperly reported there. Okay? Make sense? So this is how we do it. Again, this is related to your former question, Joseph. For financial firms, money financial items are operating assets or liabilities. Okay? Because this is their business. Make sense? Okay. Okay, this is a very real example. This is a real example actually for our beloved firm Nike. And please do not panic. Do not be afraid. If I ask you something like this in the exam, it will be something easy, a very easy and simple balance sheet. I'm not going to ask you something very complicated like this, but my style is like this. I teach you the difficult part. If you can digest the difficult example, then you can easily deal with normal or easy questions. Okay? So if you understand this one, you can easily handle any similar one. Okay? It is not difficult anyway. If you pay me your attention, you'll find it very easy. So this is the balance sheet for Nike. Of course, after reviewing the notes that details these accounts, we found the following. Let us see here. This is a reclassified or restated balance sheet. Here, cash and cash equivalents was split into two parts. Operating cash and the remaining balance is financial assets. So this is the working cash. Sometimes it is called working or sometimes it is called operating cash. Both are the same. So this operating cash was calculated as 0.5% of sales. If you go to the income statement of Nike discussed in lecture 1, you will find the sales figure there. You multiply it by 0.5% and you will get this amount. So this is the amount of operating cash estimated as 0.5% of sales. The remaining balance, this one, this is the balance, minus this one is the remaining balance to be treated as a financial asset. It is reported here. So this amount is the original amount of cash and cash equivalents minus the operating cash. Make sense? Make sense? Okay. So I will show you what we did here. I will show you what we did. So cash and cash equivalents have been split between operating cash and interest-bearing cash investments. So this one is financial assets. So this is what happened. This is the original balance, 3079.1. It was split into two parts. The first one is 95.1, and that is estimated as 0.5% of sales. This amount is the operating cash. Okay? And the remaining amount, this minus this, is equal to 2984. This one is treated as a financial assets, cash equivalent. Okay? Make sense? This one. Hey. Make sense? I will give you these details in the exam if I ask you something like this. I will give you all the details. I will tell you, for example, cash and cash equivalents contain so and so. For example, accrued liabilities contain so and so. So it is very easy to deal with. Once you have become aware of what items to be classified as financial and operating, then the restatement is very easy. The second item is the accounts payable. According to the footnotes, it was found that these accounts payable, not all of them are non-interest bearing. Some of them are interest bearing. So in this case, interest bearing accounts payable are classified as financial liabilities and the balance as operating. So we have here, what is the original amount of accounts payable? The original amount was 1254. So here, this one, the original amount was 1254.8. 5. So we split it into two parts. The first part is the non-interest bearing. This is the part of the non-interest bearing accounts payable. Make sense? So it is 1166.3, and this one is treated as an operating liability. And the remaining balance, this one, original amount minus this one, is treated as a financial liability. Where is that? This one, accounts payable, interest bearing. This one, 88.2. So it is treated as a financial liability. Make sense? Make sense? Is it okay with you? Okay. There is another item. Under the accrued liabilities, we found that dividends payable to common shareholders was reported here under accrued liabilities. We remove it from the accrued liabilities and we add it to the equity. So this is the equity. It was 9753, and after we add the dividends payable, it becomes 9884.4. So accrued liabilities, the original amount was how much? Go to the original balance, 1904, 1904.4. It was split into two items, or in other ways, or alternatively, we can say that dividends payable was excluded. So this is the amount after excluding the dividends payable. It is how much, the dividends payable? Could anyone please calculate the difference? 1773.7. This is operating liability. This minus this is how much? 1904.4 minus 1773.7. Could anyone please have a, do you have a calculator? Please do it, please. I think should be 130 something. 130.7? Huh? 130.7, right? Okay, that's correct. So this is 130.7. This is dividends payable added to equity. Make sense? Make sense? It is dividend payable added to equity. So this is the original amount of the accrued liabilities. We exclude the dividends payable and we add it to equity, and the remaining balance, this minus this is the remaining balance, is added or classified under the operating liabilities. Make sense? Here, this one. Okay? Now we have finally notes payable. As we can see, we find, according to the notes, that all the notes payable, they are interest bearing. Because all of the amount is interest bearing, we do not split anything, we just report them under the financial liabilities. So this is the notes payable reported under the financial liabilities. Full amount. Make sense? As you can see, it is, I would say, a lot of fun to do something like this. Very interesting, really. Once you understand the meaning or the definitions of each, you can easily classify the balance sheet. It is not difficult to deal with the balance sheet. The most difficult one is the income statement, as we shall see shortly. I will explain it in greater details, and I need your full attention because the students, they normally struggle with the income statement. Okay. So as you can see, when you reclassify or restate the balance sheet, we can have a look on how the firm invests in operations and how the firm relies on operating liabilities, and also how the operations are financed by financial items. Okay. Now we go to the income statement. This is the standard income statement. This is how it is normally reported according to the following standard format. We normally start with net sales, or sales minus sales allowance and retains. Then we add other revenues, and we subtract cost of sales. Sometimes it is called cost of goods sold. The same. Cost of sale is the same as the cost of goods sold, okay? The difference between gross revenues, or total net sales plus other revenues, minus cost of goods sold gives you the gross margin. Sometimes it is called the gross profit. The same. Gross margin, gross profit, it is the same. Then we subtract other operating expenses, such as marketing and advertising expenses, such as general expenses, such as admin expenses. Then we have other items, non-recurring items, like restructuring charges, merger expenses, gains and losses on asset sales, blah, blah, blah. And then we have research and development expenses. This one sometimes is lumped together with general expenses. And we have interest revenue. Sometimes it is called interest income. The same. Interest revenue and interest income are the same, equivalent. Then we have interest expense. We take the net, and to calculate the net interest expense or net interest income, we add any other financial gains and losses, or subtract. It depends on whether we have a gain or loss on financial assets. And also unrealized gains and share of income of subsidiaries. And finally, we arrive to the income tax. So the income tax is equal to the gross margin minus or plus these expenses or gains. Okay? So the income tax is applicable to these items. Note something, that after the income tax is calculated, we have income before extraordinary items and discontinued operations. Any gain or loss reported beneath the income tax line, such as gains and losses from discontinued operations, such as abnormal gains and losses or extraordinary items, any gain or loss reported beneath the tax line, usually they are reported on after-tax basis. So you do not need to deal with them or to allocate the tax on them. They are usually reported on after-tax basis. Okay? So the tax applies to the income or losses that are above the tax line. Okay? The difference between the margin and these expenses or gains, it depends. Okay? Then once we have added the extraordinary items, we have the net income or loss. If we have subsidiaries with minority equity, then we subtract that part of the income that belongs to others in our subsidiaries. Then we get the net income to shareholders. If our firm has preferred equity and they are entitled to dividends, we need also to subtract preferred dividends. And then we arrive at net income to common shareholders. Okay? So it depends. If our firm has preferred equity holders and they are entitled to an amount of dividends, in this case we subtract it from the net income, and that will give us the net income to common shareholders. Okay? This is the standard income statement. Yes, please.
When it says non-controlling interest share in subsidiary, because there's already been taxes paid by this entity, how does that affect the tax paid by the controlling
it is on after-tax basis, how much it belongs to them. Okay? So here we subtract the income that belongs to others in our subsidiaries after taking into consideration the tax paid by the subsidiary. Okay? And the net income of the subsidiary. Okay?
So if they make a lot of controlling interest, if they mean after tax, right?
Yeah. Yeah. Okay. So here, again, the key idea is to separate operating items from financing items. And note that once we have separated operating items from financing items, operating items also need further, let us say, split. We need to calculate the operating income that comes from sales and isolate it from other operating income from sources other than sales. Make sense? That will make it easier for us to see where most of the value is coming from. Is it coming from the sales of the firm? Because this is where most of the value should come from. Or from other sources. If it is from other sources, there is a problem here, because other sources are non-recurring in nature. So we need to focus on where the bulk of the value comes from. It should come from sales. Okay? Most of the income should come from sales. So it is very important to make this distinction between operating income from sales and operating income from sources other than sales. We need also to do the tax allocation. And something else very important, we need also to restate the income statement such that we report the comprehensive income statement, which means that any gains or losses reported under the equity section should be also reported under the restated income statement. Make sense? So in other ways, we need to see the full picture. When we restate the income statement, we need to see the full picture. Operating income from sales isolated from other operating income. Other non-recurring items also should be taken into consideration. Gains or losses reported under the equity section should be also reported under the income statement. So we have the full picture and also properly broken down or properly split or classified. Make sense? That will make it easier for you for the purpose of analysis and forecasting. Okay? Because when you build your forecasting, you should focus on the major sources of value rather than items that are non-repeating, items that do not recur frequently. Infrequent items should be excluded when you build up your forecast. Make sense? We will discuss this point in greater details when we talk about the forecasting techniques. So this is how the restated income statement should look like, and please again, do not panic. I'm not going to ask you something like this in the exam. Okay? This is just for your info. In the exam, you will see a question similar to the one in the workshop. There is a very simple income statement in the workshop. It will be something like that. I'm not going to, but you have to understand what's going on here. Okay? We have to discuss them. So this is what we do here when we restate the income statement. We calculate the operating income before sales, before tax, operating income from sales before tax, and that is equal to sales minus expenses to generate sales. This one is, again, cost of goods sold. Because all the expenses incurred to generate sales are usually lumped together as cost of goods sold. Sometimes it is called expenses to generate sales. The same. So sales minus cost of goods sold gives us the operating income from sales before tax. I'm sorry. This one also include other operating costs. Other operating costs that are also necessary to generate sales. The next step is to allocate the tax. We need to split the tax and calculate the tax, split it such that we need to calculate the tax that is on the operating income from sales and the tax on other operating income from sources other than sales. So we need to make a tax allocation. We need to allocate the tax between operating income from sales and operating income from sources other than sales. Okay? Okay. So this is how we calculate the tax on operating income from sales. We take the reported tax. If there was net financial expense, we calculate the tax benefit on the net financial expense and we add it to the tax reported. But if there was net financial income, we subtract. So or minus tax on net financial income. It depends. It depends on whether we have net financial expense or net financial income. And we subtract the tax allocated to other operating income from sources other than sales. Make sense? If this is the case, in this case, this is the tax on other operating income. What if we have other operating expense? In this case, we add or put or plus tax benefit on other operating expense. It depends on whether we have an income or an expense. Make sense? Once we have done that, we get the operating income from sales after tax. Then we calculate other operating income or expense. We calculate the sum and also we put the tax on this sum. And then we add other operating items. These ones are usually on after-tax basis. These ones are usually on after-tax basis. We do not need to worry about the tax allocation. As we can see, these two are usually reported under the income statement, but these two are usually, this one in the equity statement, and this one is hidden, and we need to find it out if it is there. We dealt with an example about this one last week. You still remember the losses on exercise of options? Call options, yeah. Now, once you have done that, you can calculate the operating income after tax. Sometimes it is called enterprise income. Sometimes it is called net operating income after tax. NOPAT is the net operating income after tax. Okay. So this is the formal name. Sometimes people in practice, they just say operating income. Okay? You need to make, to be, or it is your duty to know what we are talking about. Are we talking about after tax operating income or before tax? If it is before tax, you should calculate the after tax and use it in the valuation, okay? Then we do also similar treatment to the net financial expense. We need to calculate the after-tax net financial expense or the after-tax net financial income. It depends on whether we have an expense or income. So we take the interest expense, we subtract interest revenue or interest income, then we add any gains and losses on other financial assets and liabilities. Okay? And we have then the net taxable financial expense before tax. It depends. It could be net financial, again, net taxable financial income. It depends. Then we calculate the tax benefit on the expense plus the tax benefit, or the minus the tax. Again, it depends. I have to remind you again and again, it depends on whether we have an expense or an income. Then we add gains and losses on other financial items that are usually reported on after-tax basis. These are already on after-tax basis. This one sometimes is, tax deductible, the loss on the redemption of preferred stock. Sometimes it is tax deductible. If this is the case, you take into account the tax benefit and calculate the after-tax loss or gain. It depends. Now, once you have, remember that all of these items are to calculate this one. So net financial expense equals this, so. Okay? Once you have calculated the net financial expense after tax, we subtract it from NOPAT. So NOPAT minus net financial expense minus non-controlling interest share in subsidiary income. That gives us the comprehensive income to common shareholders. Make sense? Again, don't be afraid. I'm not going to ask you something like this in the exam. But I am sure, or I believe that you understand what's going on, huh? We just deal with the income statement as given. We make proper classification, and we import gains and losses from the equity section and report them here in the income statement. Financial items are reported here, and operating items are reported here. Okay? Okay. Let us take a break. Okay. Now let us see how the tax is allocated between operating income from sales and other operating income. First step is to calculate the tax benefit on net financial expense or tax on net financial income, and that is equal to net financial income times the statutory tax rate, okay? So it depends on whether we have a net financial expense or net financial income. If we have a net financial expense, we have a tax benefit. If we have a net financial income, we have a tax on this income, okay? Here, when we calculate the benefit or tax, we use the statutory tax rate. This is the government tax rate imposed on government, on corporate firms. For example, in Australia, the statutory tax rate is how much? The corporate tax rate, how much? 30%. So this is the statutory tax rate. There is something called the effective tax rate. Don't worry about this one. It is calculated as tax on operating income divided by operating income before tax, equity income, and extraordinary and dirty surplus items. Don't worry about this one. Just take the government tax rate and use it to calculate the tax benefit on expense or the tax on income. The next step is to calculate the tax on operating income. Tax on operating income is just equal the reported tax plus the tax benefit. This is the tax benefit on net financial expense, or minus the tax on net financial income, or minus net financial income times the tax rate. So it depends on whether we have an income or an expense. Okay? So this is OR, huh? Why do we add the tax benefit or subtract the tax on income? The idea here is to calculate how much the tax on operating income should be if there was no tax saving or extra tax on financing items. So we need to isolate the effect of financing items on tax. You remember? I will show you now a very simple example. Let us say that the tax rate is 30%. This is the tax rate. Let us assume that a firm has EBIT. The EBIT was 100. The interest was, let us say 40. And 100 minus 40, how much? 60. This is the earning before tax. What is the amount of tax here? 60 times 30, how much? 18. What is the after the net income here? 60 minus 18, how much? 42. Okay. Now assume the firm didn't have the interest expense. Now we have 100, we have 0, we have EBIT equal to how much? 100, and the tax on 100 how much? 30, right? The tax on 100 is 30. The net income is how much? 70. As you can see, because the expense here, interest expense, because it is tax deductible, the tax bill was reduced from 30 down to 18. So the interest expense reduced the tax bill from 30 to 18. So we say that the tax saving is how much? 12. So 30 minus 18, that is the tax saving. Alternatively, we can easily calculate the tax benefit or saving. Saving, benefit are the same. When we say tax saving, it is the same as the tax benefit, okay? So the tax benefit can be straightforwardly calculated as the interest expense, 40, times 30%. How much? 12. See? So the tax benefit or saving is 12. So because interest expense is tax deductible, we reduce the tax bill from 30 down to 18. Right? So there was a tax saving. This tax saving reduced the tax bill. Okay? So when we calculate the tax on operating income, we add back this tax saving to isolate the effect of the financing item, which is the interest expense. It is a financing item. We need to calculate how much the tax on the operating income should be if there was no tax saving on interest. And if there was tax on net financial income, we subtract, because the financial income, if there was an income here rather than interest expense, if it was interest income, in this case the tax bill will be increased, right? So we isolate the effect of this extra tax by subtracting the tax on the net financial income. You understand the idea now? We need to isolate the effect of financing items from the operating items. Make sense? Okay. This is a simple example. Assume the tax rate is 30% and we have a firm with revenues 4,000 and operating expenses 3,411, and the interest expense is 100 and the income before tax is 500. The tax bill is 150. This is the net income. There are two methods, the top-down approach or the bottom-up approach. Under the bottom-up, we start with net income. We add the interest expense and calculate the tax benefit. So this is the after-tax net interest expense. We add the after-tax net interest expense to the net income. We get the operating income after tax. This is the bottom-up approach. It is not very informative, so we prefer the top-down one because it is more detailed and more informative. So we calculate the operating income before tax as we used to do, and then we calculate how much the tax on the operating income should be if there was no interest expense. So we take the tax reported and we add the tax benefit on net financial expense. Okay, so this is the reported tax 150 taken from here, and then we calculate the tax benefit on net financial expense as the expense, the interest expense times the tax rate. So this is the tax benefit. We sum them together, and this is the tax on operating income, right? Or this is how much the tax on operating income should be if there was no tax deductible interest expense. And the evidence of that is that if you multiply 600 times 30%, if the full amount here is tax deductible, you get 180, right? If the full amount 600 is tax deductible and there was no tax, no interest expense, in this case the tax bill will be 180. Make sense? Clear? Okay. So this is the after-tax operating income. Okay? This is a very simple example. Now let us see how to calculate the tax on other operating income and the tax on operating income from sales. Tax on other operating income or expense, be careful. It could be tax saving on other operating expense. It depends. It is equal to other operating income times the tax rate, or other operating expense times the tax rate. It depends. Once we have calculated the tax on other operating income or the tax saving on other operating expense, we subtract it from the tax on operating income. Remember, tax on operating income is equal to reported tax plus the tax saving on the net financial expense, or minus the tax on net financial income, plus or minus net financial income times the tax rate. So this is the tax on operating income. This is the gross figure. Now we break it down into two components: tax on operating income from sales and tax on other operating items. Make sense? So tax on operating income from sales is equal to the tax on the full amount of operating income minus the tax on other operating income. Again, I would like to remind you, this one could be or plus tax benefit on other operating expense. So it depends. If it is an expense, we add the tax benefit. If it is an income, we subtract the tax on this income. Make sense? Okay, let us see a numerical example and you will see how easy it is. Trust me, it is easy. I will explain it in slowly. This is the income statement of Nike for 3 years. So we have cost of sales, we have revenues, cost of sales, and this is the gross profit. This is the other operating expenses. We have also here other income or expenses. This one is normally should be moved to this one and added to this one. And we have interest expense of 6.3. Okay, now let us see how to deal with this one. And this is also the equity statement of Nike. We handled this one last week. You remember last week? You remember what we did last week? Now we are going to prepare the restated income statement for Nike. We do the proper restatement here in the income statement, and also any gains and losses reported in the equity section here should be also reported in the income statement in order to calculate the comprehensive income. Okay? So let us see how to do that. So we start with revenues. We subtract the cost of sales, and that will give us the gross margin. Then we subtract other expenses, operating expenses. This is operating expense, operating expense, operating expense. Note that these two is the sum, or the sum of these two gives you the selling and admin expenses. The author of the textbook, he decided to split the figure into two items. It is not necessary to do that. It is useful to do something like this, but it's not a big deal. You can take this sum and use it here instead of these two components. It's not a big deal, okay? It's not a big deal. So these two items is just the breakdown of this one. Okay, he decided to split it into admin expenses and advertising. Okay, that's fine. And he took also the other income or expense here, this one, he reported here. And then the gross margin minus the other operating expenses. So this minus this minus this plus this gives you this. So this is the operating income from sales before tax. Before tax. Make sense? Okay, up to here is very clear, huh? Now let us see how to calculate the tax on operating income from sales before tax. We take the tax as reported. This is the tax as reported, 610.2. And then we search for other operating income or expenses and also the net financial expense and income. Here we do not have any other items, so no need to worry. So we go down to the, here we do not have anything, as you can see. We go then to the financial expense. We have 6.3. It is interest expense. So because it is interest expense, there is a tax saving. Should we add it or should we subtract it? We should add it. So this is the tax saving on the net interest expense. It is equal to 6.3 times the tax rate. This is the tax rate. It is given to you in the table. Okay? It is 36.3%. So we sum them together, and this is the tax on operating income from sales. Make sense? It was a tax benefit, right? Because we have net interest expense. Now, this operating income before sales, operating income from sales before tax minus the tax on this operating income gives us the operating income from sales after tax. So this minus this is the operating income from sales after tax. Make sense? We do not have any other operating items here, so we do not need to worry. Now we go to the second group. The second group contains gains and losses that are usually reported in the equity section of the balance sheet, these items. So we take them from there and we report them here. You remember? From the equity statement, these items, this, and this. Okay? We report them here, and then we add them together. And that gives us the operating income after tax. Remember that these items that are taken from the equity section already on after tax basis. We do not need to worry about them, about the tax treatment. We take them as given. Okay? Make sense? So we have now the operating income after tax. The next step is to subtract the net financial expense also after tax. We have only two items here. We have interest income in the footnote. If you go to the footnote, here it doesn't show us, but if you go to the footnotes, if we have the annual reports and go to the footnotes, we find that 6.3 is the net of these two amounts. So we have interest income 30.1 and interest expense 36.4. The net is 6.3. This is a net financial expense because the interest expense is greater than the interest income, right? Right? So we have net financial expense. The next step is to calculate the tax benefit or saving on this expense. It is the tax rate, 36.3% times 6.3, and that gives us the tax saving. Then we calculate the after-tax net financial expense. So this amount, 4, is this minus this, okay? Or the sum of the two. If you keep this one negative, then you take the sum, okay? There is a preferred dividend. It should be added to the net financial expense to calculate the gross amount after tax. But because it is less than $500,000, ignored. This is the practice or the tradition in practice. If any item is less than $500,000, it is normally ignored. We ignore it. We do not care about the calculation. Okay? You can add it if you wish. It's not a big deal. Okay? Do you understand this one? Is it clear? Ask me. Don't remain silent. If you have a problem with any part, ask me. I'm happy to repeat any part. Just ask me. Do you understand how to deal with this one? Okay, now let us go to 2009. It is more difficult and see how to deal with it. Again, we take the sales figure as reported, and this is the cost of sale, and this is the gross margin, and this is the breakdown of the selling general admin. We break it down, and this is the other expense or income. Then we take the difference, this one minus this, minus this, plus this. We have the operating income from sales before tax. Now, the trick is to calculate the tax on this figure because we have two things here. We have other operating income or expenses, and we have also a net financial income. So here it is reversed. We have other operating expense rather than other operating income. And here we have net financial income rather than net financial expense. Okay? So, as we can see, all of these are others. they do not belong to the sales activity or the sales of the firm. These are non-recurring items. They do not repeat. They are not frequent items. As we can see, all of these numbers are negative, which means that there was a loss, or the sum here. This is the sum of these three items. It is a loss. The loss is tax deductible, so there is a tax saving. We multiply the loss, this is the loss, times the tax rate, and we get the saving. This is the saving. 216.5 is equal to the loss times the tax rate here. That will give you the saving. And this is the after-tax amount of loss. So this amount is the loss minus the tax saving, and that gives you the after-tax loss. I'm sorry that the author of the textbook, he sometimes put the loss between parentheses, sometimes he doesn't put. I'm sorry for that. It is your duty to know when to add and when to subtract, okay? This amount is loss, and this is the tax saving, so you should subtract this from the absolute value of this to get the after-tax loss. Make sense? Okay. And something like this you will see even in practice when you analyze the financial statements of firms. Sometimes negative numbers are put between parentheses or brackets, sometimes they are not. Sometimes cash inflows are given a negative sign, sometimes they are given a positive. So it is your duty to be aware of what the firm is doing. Okay? Firms in practice, they do not stick to a standard way of reporting the statements or dealing with the signs of the cash flow or items. Okay? That is your duty. Once you have looked at these ones, so you should figure out that these are losses because they are between parentheses. So the sum here is a loss, and this is the saving, and this is the after-tax loss. Make sense? So this tax saving should be added or subtracted? Any saving should be added to the reported tax. Any saving, tax on a loss, tax saving on a loss should be added. Any tax on an income should be subtracted, whether it is other operating income or net financial income. Okay? Here we have a loss and a tax saving. The saving should be added. Here, when we go down to the financial expense or income, we have here, if you go, we do not have the original one, but here we can see this is interest income, this is interest expense. The difference is net financial income. The difference is net financial income rather than expense. And this is the tax on the income, and this is the after-tax income. Okay? So this tax is just the net financial income times the tax rate. Make sense? So this is the tax on the net financial income. Now, so what should we do? Should we... This is the tax on the net financial income. Should we subtract it or add it? Subtract it, right? So the tax here, this tax figure, is equal to the reported one plus 216.5 minus 3.4. And this is the net of the two. 213.1 is just this one. 216.5 minus a 3.4. Okay? Okay? So this figure is equal to this, 469.8 plus, let me write it down for you. This figure is equal to the reported one, 469.8, plus the saving on other operating losses, 216.5 minus the income, the tax on the net financial income, 3.4. Okay? Is it clear? So any tax saving on a loss or expense should be added, and any tax on an income or net financial income, operating income or net financial income should be subtracted. Make sense? Now, if you understand this one, you can easily deal with the question that you will see in the exam, and it will be similar to a question in your workshop questions, okay? It's not really difficult. This is an explanation to what we did, okay? I already explained these things for you. Okay. So once you have restated the income statement, we can see how the firm's strategy generates earnings, how sales are translated to operating income, and how the financing strategy affects the shareholders. There is a useful metric or measure that we will use it later on in the valuation. It is called residual operating income. The idea here is similar to the residual income. There, if you still remember the residual income model, there we calculated the residual income or extra profit as the difference between earnings and the product of the required return on equity times the lagged book value of equity, right? Here, the same idea, but we use the operating income minus the required return on net operating assets. Okay? So here, the residual operating income is equal to the operating income at time t minus the product. Remember that this one is the cost of capital, the required return on operations. This is what we call it weighted average cost of capital. You know the meaning of weighted average cost of capital? Okay. It is the required return or the weighted average required return, required by whom? By both shareholders and the creditors. Okay? Normally, this figure is supplied to you straightforward to use. Okay? Normally, I give it to you in the exam, so you just need to apply it in the calculation. So, we multiply the cost of capital or required return on operations times the lagged net operating assets, and then we subtract the product from the operating income, and that gives us the residual operating income. This residual operating income, later on we will see how to use it in order to value the whole firm. We value the whole firm, and once we have valued the whole firm, we can value its equity by subtracting the net debt from the value of the whole firm. We will discuss this model later on, don't worry, not now. Okay. Now, once you have restated the balance sheet and the income statement, the next step is to analyze these statements. Okay. For the purpose of the assignment, I do not want you to restate anything because that will consume a lot of your time. Don't worry about that. Just use the most popular ratios in the given in the reported statement, and you'll be fine. Do not restate the income statement and the balance sheet. It takes a lot of time. But in practice, remember, in practice you need to restate the statements before you analyze them. Okay? Analysis. Normally, we can compare the performance of our firm with other firms, and this kind of analysis is called cross-sectional analysis. It would be better if we compare our firm with its peers in the same industry. There is another type of analysis, it is called time series analysis, where we compare the performance of our firm relative to its performance in the past. So we see the trend in its performance indicators. Okay? There is something also called common size analysis. It is very useful also in the cross-sectional type of analysis. According to the common size analysis, for the income statement, we divide each item by the total revenues, and for the balance sheet, we divide operating items by the total and financial items by the total. Sometimes each item is divided by total assets. This is for the unrestated statements. if we deal with the balance sheet as given, we divide each item by total assets. But it would be better if we make the analysis for the restated statements. Okay, let us see an example. Common size analysis for Nike and General Mills. This is the income statement. Common size analysis for the income statement. So this is the income statement for Nike. This is the income statement for General Mills. Each item in the income statement is divided by revenues. So revenues is divided by itself, that is 100%. Cost of sales is divided by revenues, that is 53.7%. Gross profit is divided by revenues, that is 46.3%, and so on and so forth. Every item is divided by revenues, and we do the same for General Mills, and then we compare the ratios or the percentages to see where each firm is outperforming the other or underperforming relative to the other. For example, look at the ratio of the cost of sale for Nike and General Mills. The cost of sale here is 53.7%. Here it is 60.3%. So in terms of the cost of sales, we can say that Nike is more efficient, right? Nike is more efficient. 53.7%, it means that each dollar of sales was absorbed by, or each dollar of sales, how to explain? Cost of sales absorbed 53.7 cents of each dollar of sales. Okay? This is the meaning. Cost of sales absorbed 53.7% of each dollar of sales. This is the meaning. The lower the ratio, the better. Okay? So this ratio is less than this one, so we can say that in terms of cost of sales, Nike was more efficient. In terms of admin expenses, this one is higher than this, so this one is better. In terms of advertising, apparently, Nike spends more on advertising expenses relative to General Mills. As we can see, the bottom line here, comprehensive income, this is the bottom line, and this is maybe the most important figure. The higher the ratio, the better. The ratio here is 9.2%. It means 9.2%. It means that each dollar of sales ultimately generated a net profit of 9.2 cents. And the remaining, the difference was consumed by what? By other expenses. Okay? This is the meaning. Okay? So when we compare these two ratios, we can see that Nike was doing better in that year, did better than General Mills. Each dollar of sales generated a net profit of 9.2 cents. For General Mills, the ratio was 6.2. So each dollar generated a net profit of 6.2 cents. Okay? And this is the common size analysis for the balance sheet of the two companies. This is the operating section. Each operating asset is divided by the total. So we divide the operating cash by the total operating assets. We divide the accounts receivable. This is receivable, not renewable. This is a typo. This is accounts receivable. We divide it by the total operating assets. And we do the same for the operating liabilities. We divide each operating liability by the total. This one divided by this gives you this. This one divided by this gives you this. Okay? As we can see, Nike maintained in that year Nike maintained only 1% of operating assets as cash. If you divide operating cash by total assets, it will be far less than 1%. And General Mills maintained only 0.4%. Okay? Any other ratios? Look at the accounts receivable. Apparently, Nike was very aggressive in its credit sales. Imagine accounts receivable represented in that year 28.3% of the operating assets. The ratio here is much higher than this one. That's too much. Apparently, Nike was very generous in selling on a credit, right? What else? Any other ratios? Look at the inventory. Inventory also was very sizable relative to the total operating assets. What else we have here? Operating goodwill. As we can see, each ratio gives us useful information. Each ratio tells us something. We can do also trend analysis. We need to select a base year. So assume that the base year is 2005. We divide each figure in subsequent years by its value in the base year. So for example, these are percentages. Be careful. Percentages. Okay? So in 2006, we divide the sales figure in 2006 by the sales figure in the base year, and we multiply by 100%, and that gives us 108.8. 108.8, it means that the sales figure in 2006 was 8.8% greater than the sales figure in 2005. Okay, this is the mean. We do the same every year. We divide the figure by its value in the base year. For example, in 2010, as we can see, this is percent. We can say here that the sales in 2010 was 38.4% greater than the figure of sales in the base year. Okay? So look at the trend here. There is an upward trend, continuous increase in the sales relative to the base year. There is only a little minor decrease from here to here. Not a very sharp decrease. Little decrease. Look at the comprehensive income to common. In 2006, there was an increase in the comprehensive income relative to the base year. The increase was 6.7%. Then there was another increase by 22.4%. And then there was a huge jump. As we can see, this is a very big jump, right? And then down, this ratio decreased down to here. Again here. So as we can see, there was something unusual happened in this year. Something unusual happened in this year. It is your duty to go to the income statement of the firm that year. If you see something like this when you analyze the trend of any the trend in the indicators of any firm, if you see something like this, something unusual, you need to dig and search for this unusual jump and remove the effect of the unusual event. Okay? Before you use it in the forecasting. Because you can use this trend, for example, in forecasting. You can calculate, for example, the average growth to forecast the growth in earnings, right? For example, If you see something unusual like this, you should remove the effect of the unusual events and normalize the ratio before you use it in the forecasting. Okay? Also, there are some useful ratios that are used in practice. For the income statement, these are the most popular ratios. Operating profit margin is the operating income after tax divided by sales. This is a very popular ratio. We have also sales profit margin. It is the operating profit from sales divided by sales. We have also other items profit margin. This is the operating income from sources other than sales divided by sales. We have the net profit margin. This one also is very popular. It is the comprehensive net income divided by sales. We have the expense ratio is the any expense divided by sales. Note that 1 minus sales profit margin is the sum of expense ratios. We have also financial leverage ratio or ratios, two ratios that are very popular. One of them is the capitalization ratio. It is the net operating assets divided by common shareholders' equity. We have also financial leverage ratio. It is the net financial obligations divided by common shareholders' equity. Note that this one minus this one is always equal to 1. Why is that? I'll tell you why. Remember that net operating assets is equal to NFO plus common shareholders' equity. And that is equal to net operating assets minus NFO. That is equal to common shareholders' equity. Now, if you divide both sides by common shareholders' equity, divide this by common shareholders' equity, this one is the capitalization ratio, and this one is the leverage ratio. This minus this equal 1, because common equity divided by common equity is 1. Make sense? Make sense? Okay? Okay. There is also another kind of leverage called operating liability leverage, and that is equal to operating liabilities divided by net operating assets. We will see how to use these ratios later on in the valuation. We have also operating profitability. It is the return on net operating assets. This one will be used later on in the analysis. It is equal to operating income, again, after tax, divided by the average net operating assets. Or sometimes we use operating income at time t divided by the lagged net operating assets at time t minus 1. It depends. I told you in the past, last lecture or the lecture before, I told you that we use the lagged if there was no addition during the year. If there was an addition to net operating assets during the year or to equity, we use the average. Okay? We use the average. The same applies here and here. There is also financing profitability or measure of the financing cost. Financing costs. NBC. What is the NBC, by the way? Net borrowing cost. That's true. It is not the National Broadcasting Company. It is the net borrowing cost, and that is equal to net financial expense divided by the average net financial obligations or the lagged. It depends, as I've said before, whether we have an addition or not. There is also the return on net financial assets, and that is equal to net financial income divided by the average net financial assets. Okay? Very intuitive ratios, very intuitive. Okay. So remember the steps. First step, we reformulate the statement of shareholders' equity on a clean surplus basis. Then we need to calculate the comprehensive rate of return on equity. Don't worry about this one. Now you know what to do. You know what to do. Okay, this is it. Any questions before we leave? Please, wait. Any questions? Any questions? Okay. So what I suggest when you go home, read the lecture notes carefully and listen to the recording. Okay? If you still have problems, come to me. I am there. I am almost every day available in my office. You can find me there, okay?